Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back to the show. This is episode 245, May Market Update. Connor, Corey, thank you both for joining me on Upticks.
Thanks for having me.
Happy to be here.
And Corey, thank you. Special thank you for subbing out for me last week. I believe that's when I was out in Dallas, wasn't it?
Correct.
Yeah, so for our viewership and our audience, I'm very pleased to present that I just completed a year-long program with the Stagen Academy. It's a wonderful group out of Dallas, Texas, where I was able to polish up my leadership skills. So I learned a lot about purpose, vision, inspiring our team and our clients. And I met some amazing people and got coached up at such a high level. I can't thank John McGraw enough for referring me to that program. I think anybody in a leadership position should consider getting coaching. And I think Stagen is one of the best in the country at what they do. So Corey, again, thank you for subbing in on episode 244. If you haven't watched that already, Corey interviewed Samantha Shepard on trust responsibilities. I thought it was a very powerful episode, and it's important for anyone that has an estate plan set up. I think you can learn some quick tips from tuning into that episode. So thank you again, Corey, for joining me. Connor, thank you again. I know we just recently did a webinar also to our audience. If you go to falconwealthadvisors.com, you can check out our latest market webinar that we did, where we took a deep dive into what's going on in the stock market. And we fielded some questions from the audience. But Connor, do you have anything fun going on in your life before we get into today's topic?
Only thing I can think of is took my daughter to the zoo this last weekend, and she loved it. That was a blast. The penguins were a big hit.
Nice. And she's almost 2 years old?
That's right.
Yeah, so that's very cool. Hopefully you guys snapped some good pictures and made some memories. So that's awesome.
Definitely.
Yeah, I've seen the penguins there. I feel like the penguins is one of the biggest draws at the Kansas City Zoo for whatever reason. Maybe because
it is, and they're building a big new aquarium as well. It's supposed to be done sometime this year.
Nice. Well, that'll be cool when that opens up. Awesome. Very cool. Corey, you got anything? Any updates?
No, I'm just working on rehabbing a calf injury from the racket sport. So.
Yeah, not any racket sport, Corey. Let's be clear here. You got injured playing pickleball.
I know. I sure did.
Well, we hope you get a speedy recovery. I know it's not pleasant. We think you tore your calf muscle, right? Trying to smash the ball down. And like I said, we hope you get
That's pretty much what happened.
Yeah, so got to take it easy out there, Corey.
I know. Lesson learned.
Yeah. Well, again, we hope you feel better. And thanks for joining me on today's show. I know you're in a little bit of pain, so thank you. But for today's topic, we wanted to talk about the May market update. Here we are, guys, already 4 months into 2023, and the market's actually had quite a nice run here. And I think many investors don't really understand or realize that. So as of the recording of this episode, the S&P 500 is up around 8 or 9%. Again, that fluctuates every day. The bond market is positive. It's up around 2 or 3%. And I've got the international up here is also up around 7 or 8%. So with all three major indexes up, as opposed to down like they were in 2022, I want to talk about what's driving the S&P 500 return. It's a little bit unique from my perspective, and that a handful of stocks are driving this recovery. So Connor, I'll let you start here. Maybe you can comment, maybe not giving you specific names, but can you explain a little bit what's going on with the recovery in the S&P 500?
Yes, so you touched on it a little bit there. A large percentage of the gains in the S&P 500 come from a relatively small pool of stocks. And that pool of stocks happens to be a lot of the same stocks that were down big last year. Some of them even, cut in half. So we've seen a lot of those come back to similar levels where they started 2022.
Right. So it's been, a lot of these companies drug the S&P down, and now they're springboarding and bouncing back up. Kind of a more of a testament of why you don't want to try to time the market. A lot of people will come to Corey and I and they'll say, hey, XYZ stock is down. I want to sell it. And this is a very good proof that as long as fundamentally the company is strong and management are making the correct decisions, you can get a recovery literally the next year, right? You might not have to wait around 5 years to make all the money back that you lost in 1 year in a stock. Corey, do you have any comments on the S&P 500's, early rally this year?
I think just to really kind of add to what Connor pointed out, I think, conceptually looking at the big picture, what that's really telling us is that, for investors that are invested in the S&P 500, which has become a much more popular way over the last decade or so to invest, the reality is there's exposure to certain companies. Some companies have a whole lot more exposure than others, and you may ride them up and you may ride them back down also.
Yeah, and that's a good point, Corey, because we don't believe in S&P 500 investing with our clients. So because we feel like when you do that, you're just riding this wave up and down, and you're exposed to certain stocks that actually might not be very good, even though they're in the S&P 500. So I think that's a good point to remember for our clients. That, okay, if you lost less than the S&P 500 last year, that's great, but don't be disappointed if it's not shooting up. We don't want to throw diversification out the window on a handful of stocks doing well. You don't want to take your money out of a diversified portfolio and just go dump it in a handful of stocks. In fact, that would be very dangerous and very risky. And we would not recommend doing that. So that's, again, one of the reasons we don't invest in the S&P 500. Yes, we may lag from time to time when you have a handful of stocks that are going hyperbolic and shooting up. That's okay to us because, again, we're in it for the long term and to hit singles and doubles. And ultimately, we want to hit our clients' rate of return targets, and we're not really worried about beating the S&P 500. Good point. So we'll dust off our crystal balls. So now that the S&P or the stocks generally, not all of them, but generally are up on the year, how do we think the rest of the year is going to play out from May on? Connor, we'll let you go first.
Yes, we are getting close, we think, to the end of the hiking cycle. So we're starting to see inflation tick down. We are going to be done with rate hikes, we think, very soon. And we think that will give investors confidence on their estimations, on their projections, just to know that, okay, inflation's cooling. We're not going to see another 1.5% of interest rate hikes in a 2-month period. Things can kind of settle down here. So I think that we will finish the year in positive territory. I'm expecting more volatility as those things fall into place. But I am still positive on the year.
Good. And I know we're speculating here a little bit, but because a handful of stocks have led the charge, you think if the Fed stops raising rates and inflation continues to cool, do you think that gives room for our diversified portfolio to catch up and other industries and other companies to do well?
I do, yes. And I think, like I touched on earlier, a lot of those stocks that have been driving everything recently here, they're really they got cut in half last year. Now they're getting close to back to normal. And everything else has been chugging along at a much slower pace, steadier pace.
Got it. Good. Thank you. Thank you for that perspective. Corey, what are your thoughts?
Yeah, so I think we've talked about how the index, the S&P 500 specifically, has been driven by a handful of companies. We haven't really spent a lot of time talking about, why those specific companies are the ones that are driving things. Connor made the point that last year, absolutely, those were some of the companies that were down quite a bit. I also think that we'd almost be remiss to, acknowledge, of course, some of the up and down that we've seen in the banking sector this year, right? There's been a lot of concern around that, a lot of concern around financials. And I think that, frankly, a lot of the reason that some of those companies have performed so well this year is because of their lack of exposure to the financial sector. If we think about big tech companies, they're just not as exposed to financials. And they've been viewed as almost a safe haven for that reason. But from my perspective, I think that it seems like when more publicly traded companies are performing well, that is a positive as opposed to a handful of specific companies, maybe for a specific reason. But when we look into the future, all of our guests, Jake and Connor, your guess is as good as mine. My crystal ball over here is a little dusty and a little foggy. But I think when we look out into the future, I do think it has been encouraging the last few quarters to see that earnings have been, less bad than people expected. Earnings haven't fallen off a cliff like people were projecting in 2022, which just speaks to the resilience of the market and the reason why timing it can really be a fool's errand.
Yeah, and I've never heard somebody say tech as a safe haven, Corey. That you might be the first person in the history to ever say that. That's a random thought.
I picked up that idea somewhere. I didn't come up with it.
I see where you're going with that. So I like the end of your comment, though, and this is very critical for our audience to remember. We buy stocks for long-term capital appreciation, right? So yes, we are, and certainly Connor is caught up in the nuance of the day-to-day, week-to-week, month-to-month. He's looking at earnings reports, PE multiples, all that jargon, all that stuff. We're analyzing that and watching that. But for a client, again, you shouldn't get caught up in wanting to micromanage your portfolio or buy this or sell this, because you can really end up doing a lot of damage to a well thought out and well diversified portfolio. So it's always important to remember, when you're diversified, it's okay if you have some stocks that are way up and some that are way down, as long as your overall blend of investments is hitting your target rate of return. Then you should have confidence knowing that your financial plan is going to play out like we have it projected. So again, I know we're going over some micro comments here, but I just want to remind our audience, you don't want to try to time the market. You don't want to micromanage your portfolio and start picking things apart, because in the end, you could really mess some things up. All right, good. So let's talk about the bond market, guys, because it's a little bit more confusing for a lot of our clients. So the bond market was negative last year, which doesn't happen all that often, but it's a very obvious reason. When the Fed or when interest rates go up, bond prices go down. There's an inverse correlation there. So the bond market's up 2 or 3% this year. Connor, I know you're a bond guy from your resume and your history. Can you comment a little bit on what's going on in the bond market?
Yes. So the curve was inverted last year, as we saw, as you mentioned, all of those rate hikes by the Fed. And those are mostly affecting the short-term rates, right? So that's the Fed funds rate, the overnight borrowing rate. So what we've seen this year since the start of the year is the short end. So think 1 year and in bonds. Those yields have gone up as the Fed has continued to hike rates. But on the medium term and the longer end, so think 5 years, 10 years, those yields have come down. So prices on those have gone up, yields have come down.
Got it. Yeah, it makes good sense. And what you mean by yield curve is basically what a bond in the short term, months to years, all the way out 10 years and even 30 years if you want to look at a longer curve. But by inverted, meaning longer dated bonds were paying less interest than shorter dated, which we don't like to see. And so now, are you saying that that's starting to flatten a little bit?
It's become really more inverted on the long end, but I expect as we get closer to the end of this hiking cycle for that to normalize. And especially if we do see some rate cuts, whether that's later this year in 2024, that will normalize the curve a little bit.
Got it. So I guess what I'm hearing is that the heat got turned up on all this last year, and now it's cooling, which is allowing bonds a little bit of relief.
Yes. And investors are certainly taking advantage of locking in some of those rates on the longer term bonds. That's what's pushing those prices up.
Got it. And again, this isn't investment advice. This show is for informational purposes only. But in my opinion, I think it poses a potential huge opportunity for people to buy bonds, like you just said, and lock in some good higher yields. Some of these bonds out there are paying 3, 4, 5, 6%, and we haven't seen bonds pay that kind of interest in many, many years. And so we've been actually looking at this for certain clients as an opportunity to lock in some of these higher coupons or higher interest rates for our bond portfolios on a client by client basis. But again, this isn't advice. I encourage you to, if you want to talk about your bond portfolio, set up a meeting with myself or Corey or one of our financial planners, or certainly Connor, and let's take a look at your bonds and make sure that we're taking advantage of this current environment. Now, our clients can rest assured that we do have discretion. So it's not like you have to call us to do this. We're going to be doing this for you. But if you want to go deeper into the bond market, we certainly can do that. Corey, do you have any quick comments on the bond market?
Yeah, I think that it is, Jake, in all the time that we've worked together over 13 years now, I've been waiting for higher interest rates because that's what everybody said was coming. And now we finally have them, right? That's really what's begun in 2022. But I do think over the last year or so, it's naturally people have been drawn toward or gravitated towards, maybe even the local bank or the credit union and the, 4.5 or 5% CD for a year, for example. People are looking at the current environment saying that's not a bad return for taking very little risk. The challenge there, and part of the way that we manage fixed income for clients, both for the short term and for the longer term, is what happens when those CDs mature, right? Where are interest rates at then? So while we talk about interest rate risk and bond yields go up, it pushes prices down. Interest rate risk exists on the other side also. If you lock in a higher yield for a short-term period, but then have to reinvest in lower interest rates when those funds mature, I think all of that kind of reinforces your point, Jake, of why we want to not just stay too focused on the short term, but look out over the intermediate to longer term as well and take advantage of the higher interest rates that have presented themselves.
Yeah, good point, Corey. And it's also with all of these regional banks now at risk too. You want to be careful of your overall cash management. When we're talking about bonds, I don't want any client to have over the FDIC limits, which is $250,000 in a cash money market savings account. I don't care what the yield is. There's a lot of unrest still going on in the financial sector that Corey kind of alluded to. And so if there's an opportunity that we can take some of your cash that's in your savings account and go buy a treasury bond or a corporate bond or municipal bond or something, we can also lower that risk that your bank may go out of business, because it can happen. It's already happened. And we just want to be careful of that environment. So you definitely don't want to ignore your cash. The thought that you think you have $300,000 in your bank is the safest place is not true. Right? It might not be the safest place to have your money. So you want to be careful of that. And we can certainly help you with that as well. Another quick note on I-bonds. The interest rate just updated on I-bonds, and it's dropped back down around 4%. So I-bonds were super attractive about a year ago, and now they're becoming not as favorable as they were. And that makes sense, guys, right? Because inflation is coming down. And so I-bonds were a great thing. There are a lot of rules, though, and limitations and a little bit of complexity into buying them. So if you have an I-bond and you want us to review it, let us know. We can do that also. I don't necessarily think they may be the best option for people to keep doing, though, with the opportunity to get other favorable rates and maybe some different fixed income instruments out there. Okay, guys, moving on, I want to talk about the international markets, because with our clients, we're globally diversified. So we do have international exposure. Connor, you want to comment a little bit on why the international market's rallying a little bit this year and what our thoughts are?
Yes. So interestingly enough, the international market that we look at, the MSCI ACWI, the AWCI, the All World Country Index, that does include a lot of those same key stocks that have been contributing to the performance of the S&P 500. So we've got a lot of those in there contributing. China has been relatively flat this year. Europe has been up as well, similar to the S&P 500. So we're seeing some different things going on. The Chinese recovery here since the zero COVID policy has been lifted earlier this year, I would say has not materialized as quickly or as effectively as a lot of people thought it would. Still waiting on that. We are seeing recovery in travel and things like that, but I would say the just spending overall is not where people thought it was going to be. But again, a lot of that performance there is going to be contributed from a lot of those same stocks we mentioned earlier.
Now, clients are asking me about, sometimes they get concerned about the dollar weakening. What will that do to the international market? So if the dollar does weaken, what does that mean for international stocks?
Yeah, it'll depend on how much of their business is done in dollar denominated finance, but it's going to be, it's not going to be good for American companies, right? Because it's going to be, we have less purchasing power, essentially.
So it'd be good though for that's where I'm going with this. It'd be good for international stocks.
Yes.
Right, which is why I want to stay in international stocks. That's my point here, is that clients get nervous and worried about, oh, the dollar is weakening, blah, blah, blah. I was like, well, good news. Mr. and Mrs. Client, we have international exposure, and you will actually make money from the dollar weakening by being globally diversified.
Right. Yeah, that's the importance of diversification.
Yeah, good. So that's again, hopefully the clients or the audience is understanding that, is that, yeah, I don't like to hear about the dollar weakening per se, but that's the precise reason you want to be globally diversified, because even if the dollar weakens, you might make more money in your international investments to offset some of that weakness in the dollar. Corey, what are your thoughts?
The currency piece is what I was going to mention, was just that, around the dollar and the local currencies elsewhere, and the impact that has both domestically and abroad. But all of it, I think, speaks to the theme that we've highlighted here today, which is having a diversified portfolio is the right approach to take for a number of reasons, currency just being another one of them.
Yeah, it's good. All right, good, guys. So I want to wrap up today's show with a common question. I had a great conversation with a client yesterday, and they had a valid concern, right? They're getting older, closer to retirement, and they are a little nervous, rightfully so, about the stock market, especially after last year. And we'll just use round numbers. And they said, Jake, would it be safer for us to take $500,000 and pay cash for this house that we're going to buy? Or should we get a mortgage and take that, whatever, 80% of that and diversify it in the stock market? And they were leaning towards paying cash for a home because they thought that was safer. And my point to this was that might not necessarily be the case, because if you think about it, if you take $500,000 and you pay cash for one asset, you're putting all your eggs in that asset. So depending on what neighborhood that house is in, the mortgage market or the housing market, all of those other factors, you're saying everything in one thing. And when we invest, like we've just talked about, we're globally diversified. So we're buying companies in different sectors, different parts of the world, different types, dividend, growth, value, all that different stuff. So my argument was like, look, by diversifying it in a basket of stocks and bonds, you're potentially actually taking some risk off the table versus putting all of your money in one asset. Now, there's some other nuances going on. So again, this is not advice for people. I'm not saying go pull out all the equity of your house and invest it. That's not what I'm saying. They're also building another building, and they're doing other things. So I told them, look, because of all these other things going on in your lives, I want you to have access to your capital. I want liquidity. I want diversification. And as you get older and closer to retirement, then we can talk about paying off your mortgage. But I wanted to make sure that they stay nimble and had access to their capital. You guys have any thoughts on that?
I just have a quick question, Jake. Was this in this context, was somebody wanting to take money that was invested out of the market to pay off the house, or were they wanting to take cash that they had to pay off the house?
They wanted to take it out of the market. And again, the stock market's down a little bit, so it's not a good time necessarily to be doing that either. And so they may still have to do that while they're getting the mortgage and the refinance and all that. But my argument was like, look, you've got to, because they have a lot, they own businesses, and they're building another building, and they've got a lot going on. It's not a simple conversation. But my point is, don't think that it's a no-brainer. Like, hey, I want to be debt-free. I'm going to take all of my IRA or whatever, and that's not what this was necessarily, but I'm going to take all my money out of the market, pay off my house, I'll be debt-free. It was like, well, now you have no cash. And I think that's called house poor, isn't it? Where you have, right, your house is paid off, you have no debt, but you have no money. Right? So you want to be careful. And again, you want to talk to a fiduciary wealth advisor, like your friends at Falcon Wealth Advisors, to go through this, because and I told them this, for another client, it may make sense for them to pay off their house or not have a mortgage, right? They may have access to other liquidity within their portfolio, and they may not be doing all these other businesses and all these other things. So it's certainly case by case in there, but I just wanted to point out that don't think that putting all your money or a lot of your money in one asset, if it's a house, is the safe bet, because it might not be, was my point. Connor, you have any thoughts?
Yeah, I think just when you're thinking about your total net worth and the kind of concentration that would be, yeah, it may not always be a good idea.
Yeah, that's good. Yeah, good point. Exactly. That's what we're looking at from a net worth standpoint. So good. So thank you guys. Connor, I know you're in the office. You've got to go to another meeting here. But thank you for joining us. Thank you for all of our audience and listeners for tuning in. If you have any questions, we'll flash up our emails here on the screen. Feel free to email any of us directly, and be sure to subscribe and like our content, and certainly don't hesitate to share it. Thank you both for joining me, and we hope all of you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.